Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. We remain slap bang in the middle of results season, companies reporting left, right, and centre, and today we're gathering them together into two distinct groups. We kick off with the asset managers and with Aberdeen, which has belatedly seen sense and got rid of its widely derided vowel-free name. Its shares jumped this week, but as Julian Hofmann will discuss shortly, that has less to do with its use of the English language and more about operational progress. Another big beast of the funds world, Schroders, has also seen shares rise today on news of its own turnaround plan. Jemma Slingo is here to explain why. After that, we'll be looking at our long read this week, all about the future of mining and miners. Commodities expert Alex Hamer is here to share his thoughts on recent results from BHP, Rio Tinto, Anglo, etc., as well as what's in store for those businesses and the wider commodities complex, from copper to gold and beyond. Later on, we're also going to be discussing the big political news of the week. Germany's game-changer announcement to bypass its debt brake, end 2 decades of fiscal conservatism, and permit potentially unlimited defence spending, as well as setting up a €500 billion fund for infrastructure investment. That, as well as a series of dismaying comments from the US government, has sent European defence shares soaring this week. Dave Baxter is here to discuss the ETFs that are right for the job. We're going to start with Aberdeen, though, as I say. Julian, the E's have it. The E's have been restored to the name. For those who don't know, the word Aberdeen was previously spelt without any vowels. The company has restored them. They haven't restored the capital letter at the front of the name, but one step at a time, I suppose. They'll get there eventually. Can we talk about the context for this decision and the context and the details of the results they reported this week as well?
Yes, thank you, Dan. It was a victory for grammar, and I think everybody was very pleased all round on that basis. Aberdeen was, prior to this, a rather unloved share, to be honest, and the name was mercilessly mocked. I think to the point where at one point one of their PRs rang me up and said that we and the rest of the media were corporately bullying them. So the current chief executive has just basically decided to park that issue and give in. So I think that's definitely a sign of common sense and very sensible on his part. What was more relevant, perhaps more interesting in terms from an investor point of view, is that there are signs that this rather supertanker type company, which is the sort of bastard merger of Aberdeen and Standard Life, could be about to turn a corner because of its fundamental operational performance, which isn't something we've been able to say for years, really. And the first sign of that is that the outflows that had sort of plagued the business, which last year were very substantial, more like sort of 17 billion, have fallen very substantially. So we're to well under 2 billion now. Partly that's obviously they must have lost one or two big mandates for that figure, but on an underlying level, there were signs of investors submitting net funds to the company in certain parts of the business. So that is actually what the market was excited by, rather than the fact you can now spell the name properly. So yes, it was a very strange, a celebratory day, I think, for grammarians, but for investors, more importantly, it looks like what had been a very troubled dog type share has finally turned the corner under its new management, and it opens up sort of all sorts of interesting debates about which part of the business is performing well, which isn't. But it looks on the face of it that their interactive investor bet, which was a very substantial acquisition they did a few years ago, and was met at the time with a certain amount of skepticism, is starting to pay off, and it really does seem like II is becoming an integral part of Aberdeen's revenue growth because of its ability to attract retail investor funds, which is something that the sort of advisory side or the other sides of the business have singularly failed to do over the past few years. So there is a success story, you could say, behind this. So we're going to await it with some interest, I think.
As you say, interactive investor, the flows there were very strong over the past few quarters. That's definitely doing very well. I think it was the CIO who said it was corporate bullying about the people making fun of the name. So we're happy to join in that pile on for one final time today. But the advisor arms, you say things have been a bit more mixed there. This is, as the name implies, this is perhaps more the standard life part of the business, servicing financial advisors, offering products to them. They said in these results, I think profit was up a bit, but they said flows there have been disappointing. There are a few things they're doing to try and turn that around.
Well, the main problem that arm of the business has is that other companies, smaller companies, are basically eating their lunch when it comes to advisors. So you have like platform businesses, which are a lot further down the scale in terms of size compared with Aberdeen, but are quite good at attracting advisors to their platforms because they offer more or less the same kind of business at a relatively small management fee or maybe a subscription fee or something. Aberdeen is trying to compete with them, but with a business model that's more expensive. So you have this situation where their offering then has to change, and how can they do that? And that's probably that they need to improve things like customer service. The Standard Life business has been talking actually for quite a long time that bits of it don't work very well, and that they could improve their operations. But there's never been much sign that they've actually got on top of it. It looks like the new management team is more focused on improving that. So that is almost like the free upside to the business at the moment, where if they can get some growth in the advisor side, then that will feed across into the share price as well. So yes, it's they do have a turnaround plan that's in place, and but it'll take a little while before we see if that's succeeding or not.
And of course, then there's the wider traditional asset management arm of providing funds to all kinds of buyers, institutional, retail, advisors. So they're going to be hoping that starts to improve as well. A quick word on the valuation. I mean, Aberdeen, and partly because the share price has been beaten up for a while, and partly because it's an asset manager, it does have a good dividend yield, but the valuation, you think, is relatively attractive at this point, given what we've just said as well.
I think it's an 8 from 8, isn't it? It's like a PE 8 and a 8% yield. So you don't see that particularly often. But yes, I mean that just reflects its very beaten down nature. So if investors do get involved at the moment, they're certainly not paying a lot for the shares, and they're getting quite a big risk premium as well if the yield is now over 8% just from the dividend. I mean, the dividend has been held, but it's never been seriously under threat. So I think you could say that they're turning into a value case, or at least a turnaround value case. That might be the best way of describing it.
Well, let's turn to Schroders now. Jemma, they too have got a new CEO in place. He's launched a turnaround plan today. What does it involve? How achievable does it look? The market has responded quite well. What are your thoughts?
It has. I think part of the reason that the market responded so enthusiastically was just because there was a plan in place and they'd been holding out for it for quite a long time. And also it was coming off the back of a decent year. So profits were down in 2024, but less down than people expected. And while there were some quite big net outflows, again, they were sort of better than expected. So the new chief executive was coming from a relatively strong position. And now he seems to want to be cutting costs left, right, and centre, really. So he's targeting £150 million worth of net cost savings by the end of 2027, which doesn't leave him a huge amount of time. But there are a few ways he wants to achieve it, mainly by efficiency measures, it seems. So it's going to look like a very sort of slimmed down company over the next couple of years. And that has been one of the really big challenges for Schroders, because particularly on the staff cost side of things, it's sort of dwarfed its rivals in terms of how big its cost base is. And obviously that has a knock-on impact on the shares.
Mm. Well, asset management is I mean, I don't really like this phrase because you could apply it to anyone, but it is known as a people business as well. So cutting costs might be easier said than done, or at least come with some implicit costs of its own if you cut the wrong people or if you make the wrong cuts. So in short, how successful do we think this is going to be, or what kind of chances of success do we think it's going to have? Because these are quite aggressive moves, as you implied there.
Yeah, there's been a bit of a mixed reaction. So at the time we're recording this, shares are up 8% from this morning. So general investor base seems pretty cheery. But there have been some analysts that have chipped in saying, there are big material execution risks. So Citi was one bank which waded in with its doubts. And I think that's fair enough because with Schroders, these issues have been issues for years and years, and so far, no one has managed to effectively deal with them, really. I guess with Richard Oldfield at the helm, there is a new sense of energy that wasn't there before. And one thing that I thought was interesting was a big gripe with Schroders for a long time was that it effectively worked as a private company, but was obviously publicly traded. So the disclosure wasn't great. And analysts were constantly moaning about that, saying they just weren't getting enough information. And there seems to have been like quite a deep shift in how the new management team is approaching investors and sort of the level of information they're giving them, which seems to have been quite well received as well.
Mm. Certainly, he's begun by, I think, cutting back on the executive management side as well.
Mm.
Invariably, there does tend to be some potential for culling in those kind of areas. So he's got off to a start in that area. It was interesting, though. I mean, maybe if they're being quite aggressive on these cuts, they are perhaps being relatively conservative in their outlook for the public markets business, which is effectively the traditional asset management arm. As with Aberdeen, Schroders also has a wealth arm and it has a private markets arm as well, which has been growing in recent years. But the public markets arm, it says its aim there is just to stabilize revenues by the end of 2027, which doesn't sound particularly exciting. And that's also assuming, quote, normal market conditions. So very much leaving themselves a lot of leeway there and perhaps just showing how difficult it is for asset managers in those traditional active asset management markets. But let's talk about the dividend for Schroders, though, as well. It's slightly lower than Aberdeen, the dividend yield. There's no growth this year. It's flat because they're getting the payout ratio back to around 50%. What do we think of the shares in terms of both valuation, whether you're approaching it as an income investor or as a growth investor?
Yeah, so the dividend yield is currently about 6%, which isn't too shabby. But I think the big question will be what they do with the money that they're not paying out to shareholders. If they're using it really effectively um, to return the company to profitable growth, as Oldfield sort of promised to do, then I imagine people will be completely fine with that. But then if you continue to see the issues unaddressed, I imagine people will get a little bit restless if they're on the lookout for income. I think shares in Schroders are up by about a quarter since the start of the year, so there has been quite a notable bounce. But from a price to earnings perspective, they're still pretty cheap. So for the earnings for 2025, they're on about 12 times when they used to have about mid to high teens rating. So it still looks like a possible value play.
Mm. We have seen that pattern for a few asset managers, including Aberdeen this year, up by about a quarter this year as well. So the mood is starting to turn a little bit. Whether that's sustained, we'll see. Clearly, UK indices, or certainly large cap indices, are doing a bit better in general. But we'll keep an eye on that. We're going to turn now, though, to our long read of the week. It's on the cover of the magazine. It's on the website. It's all about miners and the future thereof. Alex Hamer, you've written about this. Let's start with the recent figures from some of these companies because, as we know, we are in reporting season. We have had them talking about the past year, giving their outlooks for the year ahead. What did we learn specifically from the figures from the big miners in the past few weeks?
I mean, to boil it down to one idea, dividends down. We've moved into a point where iron ore is trading at about $100, between $100 and $120 a ton. That's thanks to China being in a bit of a pickle in terms of its property market, and the government there has said it would inject a bit more cash into that sector in the coming year, but that will also probably involve steel output cuts, so they're not continually flooding the world with steel. Why that's important for BHP and Rio Tinto is that they make most of their profits from iron ore mines in the Pilbara. And what's interesting at this moment is how both of those major companies manage this, what the BHP chief executive has referred to as kind of a structural decline in the steel market. He's talked about it plateauing and then falling later in the decade. And what they're doing is, as you might imagine, big companies with huge cash flow. They're redirecting some of that cash into, they've been working on projects like fertilizer projects in BHP's case. Rio Tinto is putting a lot of money into lithium. It just closed a deal, a $6.7 billion deal today for a company called Arcadium, which will turn it immediately into a lithium producer. But most of all, they're putting that money into copper, be it expanding existing mines or building up new projects where permitting allows. But what that means for investors is probably lower payouts for the next 2 to 3 years. And these are some of the biggest dividend payers on the London Stock Exchange. Rio probably gets the headlines because it's still in the FTSE 100, but BHP is an important dividend company as well. And you see that through something like the BlackRock World Mining Trust, which my colleague Holly McKechnie wrote about this week. That's actually dropped its dividends and probably will do again in the next year. But the overall picture is the industry shifting gears a little bit and working out how to keep those earnings going.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Just on copper, which we talk about a lot, the industry talks about a lot, clearly a metal of the energy transition, a lot of hope is pinned on that. In the context of those companies, BHP clearly made an approach for Anglo last year, but as we touch on the piece, seems to, famous last words, but it seems to have refocused on internal copper projects for now, rather than trying to buy it in, as it was clearly trying to do with Anglo.
Yeah, I mean, once again, to boil it down a bit, Anglo's share price went up. The management itself at Anglo put together this strategy, which has proved pretty popular. So that's been one of the best performing miners of that scale over the past year, and it's now too expensive for BHP because the premium they'd have to put up to get that deal through would be enormous. But I think on the internal growth, it is an interesting picture at the moment because you've got projects like Resolution Copper in the US. They've already dug a 2-kilometer deep shaft, which is pretty expensive. This project's co-owned by BHP and Rio Tinto, make it a nice example. But because what they need to get this done is a land swap, which includes ground that one of the local First Nations groups says is sacred and is blocking it. The swap had been agreed by the government, but now it's in court. So it's an interesting test of how much the White House can ride roughshod over the courts to get something like this through, because it's become quite a political point because there are conservative organizations in the US that are pushing against this land swap on religious freedom rights or rights of religious groups, whereas the White House wants copper. I think the words were they want copper production to come home. What that actually means, I have no idea. But there is a really big push in the US to bring that production on side. Talking to a much smaller copper producer this week, they're raised the interesting point that even if you bring a lot of copper mining into the US, it's a pretty small copper producer at the moment, you still have to turn that ore, which turns into concentrate on the mine site, and then it gets smelted into the actual metal. You still usually have to ship it to Asia or elsewhere to get that done. So the US needs a whole lot of other infrastructure to be built for that to happen. But I digress a bit there.
Yeah, well, permitting always a big issue in the sector, whatever country you're in. We talk about that a lot in the piece as well. But let's talk about a different metal. Let's talk about gold for a moment, because clearly the price of gold has been on a tear. The price of gold miners slightly less so. A bit of a gap has opened up, as is sometimes the case. Do we still see potential there despite this gap?
Yeah, I think in the piece I look more at the valuations of the world's largest gold miners. So Newmont, Barrick, Agnico Eagle. What I think is interesting, I've just looked this morning at some research from Peel Hunt. Hochschild Mining, which is the South American gold and silver miner listed in London, it's been one of the best performing stocks in London over the past 2 years. Peel Hunt reckons at the current spot price, there's still about 80% upside to Hochschild's share price. And then, what if gold gets to $3,500 an ounce from the current 2,900? There's still a lot of room to improve, especially to those companies that are most exposed to the gold price. And I think there's a few companies that are hugely, hugely exposed or leveraged, like Sarabi Gold, which has been another hugely impressive performer in terms of its share price over the past year. Premier African Minerals, that's another one that's done really well. But yeah, I think there is room to run, largely because this is going back to the major gold miners, but a company like Agnico, which has been, once again, shares are way up over the past year, but it's still rated the same or even less than it was on an EV/EBITDA metric compared to a year or two ago. So people aren't pricing in the greater future profits that this gold price allows for. And there has been almost an adjustment period where inflated mine costs have cut out some of the benefit from that high gold price. But we're now into a period where the gulf between their all-in costs, so that includes OPEX and CAPEX, are now about $1,500 an ounce below the actual gold price. So that's a 50% margin when you include CAPEX that's giving you further mine life or even expansion at a lot of these gold projects, which is pretty big.
We cover a lot of ground in the piece. We're not going to have time to get into all of it now, but we do also talk about some of the smaller companies. One thing that's interesting there is the Lassonde curve and how that affects these companies and their prospects and investor interest in them. Can we talk a bit more about that and the challenges these businesses face in their kind of middle age almost, or after the initial sugar rush of the first discovery?
Yeah, and the Lassonde curve will be familiar to anyone who's dipped a toe into junior mining investment. It's a bit of a cliche, so I've snuck a cliche into the magazine this week, but which we've never done before. But it basically you get most of your investment gains, and this is in the world of you're trying to pick 10 baggers on AIM as opposed to build a sustainable long-term portfolio. But you get the most bang for your buck when you pick something that there's a fair bit of uncertainty around it. And then what management is able to do is release enough exploration data through drilling, through testing, to show that there is something there. And that's when the shares kind of pop off. And then, so that's that first part of the curve. So you might get really good share price appreciation there. And then once the reality sets in, how do we actually build a mine? How do we fund things? That's when the shares dip a little bit, because the company will probably be issuing equity. They will probably issue equity on the back of those exploration results. And that's something like the company uses an example is Empire Metals. They've got a titanium project in Western Australia, and they've raised money off the back of pretty interesting exploration results. It's the challenge in between that. So once you've actually defined what you think is under the ground and you're pitching it to investors, but you don't have a full study done, there's all these kind of rules around what you can tell investors about how profitable the mine will be, the scope of it, because junior miners have ripped so many people off in the past. There is quite a structure around it. And then it's in that period where you'll probably lose money or it won't go that far, because these management teams are trying really hard to raise little bits of money. So £2 to £5 million, for example, just to keep their studies going. Once they actually want to raise, if they wanted to raise a couple of $100 million to build a mine, it's a different story. You've got people who want to buy future production. You've got people who like strategic partners. You've got majors who might even buy in. Once you have that harder plan, it's a bit easier to raise your money. But it's that ugly in between bit where a lot of companies fall over.
A final point, rare earths, because this is a subject that's been making the headlines in recent weeks and days, of course. Minerals, specifically the minerals deal that the US is trying to strong arm Ukraine into signing. It's fair to say, though, that might not be. Clearly, the US and Donald Trump is very interested in Ukraine's minerals for whatever reason, but it's fair to say there aren't actually that many of them. At the same time, however, there are some companies looking at this area which have more potential, more prospects in different parts of the world.
Yeah, I think this has been an interesting time for people like me who've looked at the industry for quite a long. I think I partly wrote this piece because I'm coming up to 10 years looking at this sector and talking about the rare earths that are on offer in Ukraine, what Russia says it can offer is bewildering to me, to say the least, because Ukraine just doesn't have the right rare earths, which aren't that rare, and the deposits range hugely from easy to process, where you can pull out the high value metals from the basket, which are better for use in, say, wind turbines. Dyson vacuums use a certain type of rare metal in the magnet, which helps them spin faster. The more defense applications, or the metals that are better for use in defense applications, they just aren't really in the Ukrainian projects. And I was just looking at the share price of a company called MP Materials, which owns a mine in California called Mountain Pass, which has been at times over the past 20 years a bit of a dog of a project. It's not done that well for investors. It's gone bust. Now you'd think that a company that owns a rare earths mine in California is going absolutely gangbusters. The share price is up 40% since November, and it's on a bit more of a tear than that. It's up 90%, but it's still not doing huge things. And that is just like a huge, it's in the US, it's rare earths. And even if you ignore, technicalities on the exact metals they've got, the processing difficulties, the past of the mine, you know, it still seems like if you're interested in that space, you just buy it. And if you're the US government who wants to get rare earths going, you just fund it. And that hasn't happened. And from a London Stock Exchange point of view, we've got rare earths companies that they're not in the US, but for example, you've got Rainbow Rare Earths, which has got a South African project, which it's also got a lot of links with the US, and it actually has done trial mining where it sends this material to the US for processing. It's absolutely a slam dunk if you care about geopolitical strategy in rare earths. And it's done okay, but these projects are out there. They're just not getting the attention and the valuations that they really warrant at this kind of heightened period of stress over these materials.
Mm. Well, as I say, that is our long read this week. Do have a look online in print. If it's of interest to you, we, though, are going to turn to a slightly different subject, albeit we are staying with the depressing topic of Donald Trump and geopolitics, because following the rather horrifying press conference last Friday between Trump and J.D. Vance and Zelensky and the media, there has been a realization, it seems, that the US is not to be relied upon in Europe, and that has led this week to some big news out of Germany in terms of their fiscal plans, and they're abandoning their debt brake, partly with one eye on well, more than one eye on this new geopolitical reality, I think. Julian, do you want to talk a bit more to begin with about the context for this German announcement this week?
Yeah, I mean, Germany's figured out that it is entirely defenseless against Russia, more or less. And the context of this is that the election is a new government is about to take power in Germany. This will be a likely coalition again between the CDU, led by Mr. Merz, and the SPD. But prior to that, they have reached an agreement before the current parliament dissolves to lift what's called the debt brake, which was a measure brought in the aftermath of the last financial crisis, where the government could not spend an operational deficit of more than 0.35% of GDP. So it was a very, very tight budgetary constraint. And the upshot of that over the intervening years is that Germany has had all sorts of problems in renewing its infrastructure. It ran down its the Bundeswehr very notably in the 2010s. And what's been announced now is that the government will lift this debt brake, particularly for defense spending. So defense spending could be, in theory, unlimited as a percentage of GDP. And at the same time, we've brought in a 500 billion euro infrastructure fund to renew the creaking infrastructure, which is pretty obvious if you travel regularly in Germany. That there's a lot of stuff that's needs replacing, needs repairing, and this is an attempt, at least as well, to stimulate an economy that has been struggling over the last 2 or 3 years. High energy prices, a combination of deindustrialization in certain sectors, the threat from electric cars to the massive German automotive industry. And this spending package is a combination really of boosting national defense on the one hand, but also I think stimulating the economy to bring it out of its 3-year slump. So it's a defining moment and a very important one for the market. We called the DAX earlier this year as being one of the best performing indexes, and that this was likely due to the fact that it had been undervalued in the first place, but also that there were several companies that were driving the growth. One of which is quite clearly the armaments maker Rheinmetall, which has been up 50% in just a month. So yes, this is a kind of one of those jaw-dropping, mic-dropping moments where Germany actually decided to spend some serious money. It has to go through in this parliament before parliament dissolves, because when the new parliament comes in, there are enough fringe parties in that parliament who could potentially block this measure. So the CDU, SPD want to get this through now before the old parliament, before the new one comes in. So it's quite, there's a lot there. It may not, something may go wrong, but it seems to me that everybody's minds have been focused by the events of the last week or so.
Indeed. I think it relies on the Greens to get it through Parliament, doesn't it? What I've seen suggests they will back it, but who knows? I mean, I'm certainly no expert on the inner workings of the German Green Party, but on the assumption it does go through, clearly also this has come in the context of European countries, other countries, considering raising their defence spending from current levels of around 2% of GDP. I mean, this is what Donald Trump himself has been calling for. I think that's partly because he doesn't want to spend rather than he wants to see Europe spend more, but that's by the by. Anyway, the response, as you say, Julian, has been a big run-up in a lot of defence shares. Dave, you, this week in the funds column in print and online, you've looked at ETFs covering this space and how they are responding. And as is always the case in the world of ETFs, there are foibles to watch for if you're the kind of investor looking to get involved here in terms of the kind of product you may want to focus on and what these ETFs actually hold.
Thematic ETFs in particular have many a foible because, there are many different ways in which you can construct them, try and capture a theme. One thing to note is they often are very concentrated. So unsurprisingly, the top performers, such as the Global X Defense Tech ETF, has huge exposure to names like Rheinmetall and BAE Systems, that kind of thing. But there are other things to consider. For example, some of the funds try more nowadays to focus on things like cybersecurity and tech, and they have different allocations to areas such as industrials versus information technology. And one other thing to bear in mind is just their sort of geographic allocation. A lot of these funds do have quite chunky exposures to the US, but I suppose one interesting development in recent weeks has been that the US defense stocks have actually trailed their European peers for various reasons.
Yeah, not just a small performance gap as well, quite considerable, isn't there? Because whereas Europe, there's this change of mindset, and I think US shares are investors a bit more wary of government spending, perhaps contracting there. The tech aspect is interesting as well, as you say, because a lot of them focus on things like cybersecurity, which does fall under this banner, but equally is not the kind of share that will have been rising very quickly in recent weeks.
Yeah. And what's interesting is obviously you do have cybersecurity, dedicated cybersecurity and privacy ETFs too. They have been performing pretty well this year, but just not so extremely well as the defense funds have.
And of course, there's always the risk with these things of getting in at a peak level. But given the context we've spoken about, one might imagine there is more to come from this sector. We'll see. Let's talk about another aspect of this debate, because we have started to see some comments regarding, as we did at the start of the Russia-Ukraine conflict, regarding ESG funds and whether they should start to reconsider defense shares in the current context. Can we say a little bit more about that?
Yeah, so I remember you looked at this a couple of years ago without much revelation, I suppose, because it seemed like the ESG fund managers weren't really responding to the Ukrainian situation by kind of, I suppose, looking more warmly upon defense shares. But I was looking, the FT's done a piece in the last couple of days just arguing that perhaps ESG fund managers are now paying a little bit more attention to defense as an area that they could invest in. You have seen a small uptick in the kind of allocation that ESG funds in Europe do have to that sector. So, and to be fair, it's from a very, very low base, but perhaps in future you could see them kind of seeing defense as I don't know, a more noble area in which to invest.
It's interesting, isn't it? I mean, in some ways, it might call into question that, as people have done regularly over the past few years, what the question of what ESG is for if you're buying these kind of shares, because even if these companies are helping fund the defense, the literal defense effort in the Ukraine war, they are nonetheless weapons manufacturers. So it would seem like something that an ethical fund, if you would use that term, a sustainable fund, would avoid. So to me, it's not that surprising that the increase has been relatively small. Nonetheless, I think this is the kind of conversation that managers of those funds might be having, partly because they're also sad about missing out on the performance and they want to find a way to get in there. But at a basic level, it does seem to be a question of what these funds are doing, if they're holding exactly the same things as everyone else, depending on the mood of the day. I don't know.
Yeah, and maybe it makes it harder for ESG funds to actually kind of satisfy anyone because you could argue this makes ESG or ethical investing even more personal, subjective, idiosyncratic. Perhaps some people will start to kind of see defense as something that would fit in with their beliefs somehow. And therefore, as a fund, you're going to struggle to kind of satisfy everyone.
You're right. Yeah, perhaps the cohort of potential investors for these funds will reduce further. But anyway, this is clearly going to be a big issue in the world of funds, but clearly the world itself in general, sad to say, for a long time to come. So we'll keep tabs on that as best we can. For today, though, we have reached the end of the show. We have run out of time. So thank you very much to Dave, to Julian, to Alex, to Jemma, and to our producer, Maddie Apthorpe. We'll be back next week with another Companies and Markets show.